Okay, folks, welcome to Masterclass. I'm David Russell, VP of Market Intelligence at TradeStation. Most of you guys have seen these before. I'll just quickly go through some disclosures. If you have any questions, you can please use the chat and not the Q&A on Zoom. As you know, I'm going to share some links with you guys. Now, also, the good news is, or some interesting news, is that this is the last of these masterclasses I'm going to be doing at 11 a.m. I am going to start doing a weekly webinar. It's going to be called Market Trends at 2 p.m. on Tuesday, the 2nd of February. I'm going to be doing one of those every week. So we're just changing the schedule around. Going to be doing a lot of the similar things I've been doing. I hope to actually be covering some of the stuff better, more effectively, and look forward to doing that with all you guys. So if any of you guys, I'm going to be also kind of reorganizing the zip files. Some of you, you know what, some of the files are not yet. They were on the old kind of You Can Trade site, and I'm going to be reorganizing them. I believe most of you guys already have the zip files. If anyone needs, I can send them to you. I'm going to be, like I said, redoing them on, I'm going to be reissuing them on Market Insights in a new place. So if you have any issue, please email me at drussell@tradestation.com. But for now, I'm just going to go with what I've shared in the past. All these materials, like I said, I'm going to be updating when I start the new Market Trends webinar in February. All right, so, as you guys know, in the masterclass zip file that I've given you guys previously, there are a series of workspaces. And I wanted to start off with the S&P 500 here, kind of look at some of these things. And with this chart in particular, it has some interesting sort of patterns as always. So this is the ES charting that I'm showing you here. And this has, I've just found this to be, I'm not going to say it's always like, a trading system per se, but I have found that it can be some very basic indicators that when used, together can give some pretty significant signals. So yesterday, this is the cash index. Okay, so what do we see? First, the stochastics were overbought. Stochastics overbought are not always going to be bearish, but this was a clear signal. Now, the approach of using this chart is there's three real indicators I have, really four. One is outside candles. Those sometimes matter, and they mattered here. So what do we see? Stochastics, MACD, and moving average speed, and that's the speed of the 50-hour moving average. It's kind of a short-term trend indicator. Okay, now remember this has to be on the futures, because if you do the cash index, the 50-hour is completely different. Now, up here, stochastics was overbought. That's one bearish thing. MACD started to fall. That's another bearish thing. The 50-hour moving average started to fall. That's another bearish thing. We had essentially right in here 3 bearish signals all hitting at the same time. Now, another thing we had a bearish outside candle. We had an outside candle and another outside candle. You can see with these crosses. So that's actually a fourth indicator. So yesterday, of the 4 indicators on this chart, we pretty much had all 4 that turned bearish yesterday morning. Now, if you look on this is a cash index with hourly. These were 2 different daily levels, double top, short-term double top. So that's kind of an interesting example of how these signals can work. So, of course, I think a lot of people know that when we look at the index overall, we are in a really interesting and kind of tortuous triangle. I created just another chart really quick here. Wanted to kind of show you. There's the S&P with 4-hour bars. You can kind of see things a little bit better. And I think most people are aware that the 200-day moving average is coming down across here. And we also we go to the, there's a trend line like this that's pretty much just coming down and, pushing down on us. Now, there's another trend line coming up from below around here. If you want to look at this, this is now a triangle, which is one of the most annoying and tortuous things for investors. And I think that's important to realize. It's not a surprise we have a triangle here, because when you look at the market, I mean, in some ways you can say there are things could be great or they could be terrible. Most of the economic data now is showing us that the inflation is cooled. We saw some real weakness in the data yesterday, with retail sales for December being revised lower. The National Retail Federation said that the holiday season, the Christmas spending for holiday spending missed estimates by a lot. They were looking for 6 to 8% growth. It only went up 5.3. Retail sales, industrial production was bad. So December retail sales missed, November revised down. December industrial production missed, November revised down. So these are, it's hard to just, look past these. And at this point in time, you can say the Fed here, needs to pause. The problem though is, will they? And, they've signaled at this point 25 basis points in February. And the question is really, will they proceed further in March with another increase or not? And so at this point, a lot of the logic argues in favor of them pausing, but we're not sure of it. So you could say it's the best of times. Things could be great because if we have a Fed pause and the market is holding with a tight range like this, we could see an optimism rally. I also think it's important to realize that a lot of indicators of breadth and market participation, a lot of people have talked about how they've been improving. Those are also kind of important considerations. But at the same time, valuations, if we do have, if the recessionary trend kind of continues, then valuations are not particularly attractive. And then we have the risk of essentially other issues with, a potential sort of the Fed continuing to hiking can cause a squeeze upward in the dollar that can cause, more trouble. It can squeeze the VIX higher. So you can easily make an argument both ways. And when you're in a triangle like this, sometimes you kind of feel both things happening, and it's very frustrating, but at the same time, it simply requires patience and stepping back and looking at the levels and kind of appreciating where things are. Another thing I would mention is that there is a lot of cash on the sidelines. The Investment Company Institute, which analyzes mutual funds, said that there's a record amount of money in money market accounts. So again, none of these things, are very conclusive one way or another. And that's, why we see a triangle when things are unclear. So I did want to point out two other things I'm seeing here, or at least one other thing. Let's go to drawing Fibonacci retracement. All right. So if we go from here to here, this was a 50% retracement that held. Okay. Let's get rid of that one. I'm just going to erase it so you can see. Let's go here and do another Fibonacci retracement. We go from here to here. We are at another 50% retracement that's trying to hold. So I will kind of just say what I think my personal kind of the direction that I would be leaning more in is more on the bullish side. It is simply the fact that the data, when you look out into the future now, makes it difficult to really to see the Fed hiking much more. It seems to me February at this point is priced in. After those revisions we had yesterday, it seems to me that February should potentially even be in question. I think they've stuck their neck out on it. They've said it pretty clearly, and I think that's something that's out there. But at this point, the market is just looking out, and it simply doesn't believe the Fed is going to hike, after February. There's some of that price into the market when you look at like the CME futures, for they are looking at another hike in March. But the equity market, when you really take a step back, a lot of people, you can make a really strong argument that it's not going to happen. And we don't have confirmation of that. But at the same time, these economic trends are becoming kind of increasingly clear. So this is just a very frustrating spot here. And, Jesse Livermore said money cannot be made every day in the market. And, for short-term sort of levels and things, some of this is, you know, this has opportunity for some short-term sort of things. But at the same time, this is going to be a very frustrating sort of situation we're in here. The good news is for people looking to capture a direction, a move either way, is that this is not a significant range. And if a person is willing to kind of, you know, sacrifice this and not really mess around, but then to play either side of it, that is what, you know, a lot of trend followers would look to do. And I think there's a lot of reason to see why we're in this range here. So wanted to look at a few other things. I have these trading view charts that I often use, and I'm going to show you some of the things that I've been seeing. And you know, I write some of these ideas on Trading View for TradeStation. Let me actually show you some of them, because there were some interesting things popping up that were interesting to me. So I wrote this thing about the dollar, and I think it's interesting because if we look at the dollar index here, this is like my Trading View kind of everything chart. And the dollar index here had this big outside day yesterday, and this was also a 50% retracement. If we look at this article I did, there's a 50% retracement of this entire move. So, you know, the thing is if the Fed is dovish, then yeah, you know, more downside in the dollar makes sense. There's a lot of momentum at this point to the downside in the greenback. But the question is just, we have some suggestions here that in the near term, we could be kind of stabilizing. And I think that's an important thing just to realize. A lot of these, you know, pushing the weak dollar trades, buying the gold miners and stuff like that. I'm not like going to say at this point that gold has much downside. I mean, gold has had a pretty strong sort of move, and we were talking about that several weeks ago. But there's also, I think at this point, a possibility that we have kind of seen. Let's just take a look over here, like gold futures, you know, for example. I think we just need to realize that we have some levels here on gold, these levels that we're all just kind of pushing against and stuff. So, yeah, I think we need to be careful right now of expecting this weak dollar trade, strong gold to continue in the near term. To me, it's just, I'm not, you know, like I said, to me, gold probably has, you know, significant upside over the remainder of this year, but in the remainder of this month, or even the remainder of this quarter, I would at least say for the next several weeks, it's a little bit of a tricky one here. And I wanted to point that out because this has been a very clear trend. And I think now, you know, there are some signals that it needs to pause, like this thing I'm showing. Another thing is that this is, you know, I can show you the silver futures because there's another one, SI. Let's look at a weekly chart of this. And, you know, there is a trend line here. So again, there could be a strong argument for silver breaking out. There's a lot of things about silver that could be interesting. And, you know, I have been, you know, longer term kind of optimistic about it when I look at, you know, this situation. Remember, we did on Trading View an article back here at the very beginning of the year. Where'd it go? Right here. We did this back on December 23rd when gold was just pushing through 1800. So, you know, we've been watching this, and this is one thing we've been on the correct side of. So, I mean, this is, I would just say, you know, from this perspective, when you look at, you know, this move that we saw here in gold, and it, you know, did push higher. I just wanted to point out that from my perspective here, we need to, you know, kind of not expect there's reasons at this point to be not pushing the precious metals trade. That's what I'm trying to say. So that's the main thing I want to mention with that. You know, the thing is that with no real clarity on the Fed, you know, if they give some sort of hawkish sort of message, there's just some risk there. So from my perspective, it's hard to imagine a breakout before that news. And that's what I want to kind of say, you know, very often things move between news events. And at this point, it has stopped moving, and there's no clear news event until the end of the month when we get the Fed and then we get payrolls. And so that's my point, is that at this point, the movement in precious metals is probably extended and kind of tired. All right. Now let's go back to our daily chart. Let's see what's happening in some of these other things today. This is my masterclass workspace. And what I do here is, well, actually, wait, I want to let's go back and really quickly look at this retracement on the S&P. So we're holding that 50%. I had talked a lot for a while about 39.10 on the S&P. And it was an interesting level. We bounced at 39.10 many times. It has relevance going back really to the end of June. 39.10 was right around here. And you can see it was a high and a low, and we bounced at it. And, we're at 38.90. So we're at 3,900. So we are still in that area, in that ballpark. So I think that's just important to realize there is an area through here. And, if we don't revisit the bottom of this triangle, I think that this is my point, is that if we don't revisit the bottom of this triangle and we hold this level, this is going to be something where it just becomes difficult, I think, for the bears. If we hold here, this 50% retracement, if we hold the top of this price area, if we hold this 3,900 area that we've seen relevant for the last 6 to 8 months, it becomes difficult for the bears. And this is what I think is ultimately the kind of potentially bullish thesis, which is simply that there is not a lot more selling, and then you come up against that resistance and it moves higher. In fact, I did an article the beginning of this week, and I basically was noticing certain ways that this year is essentially it looks like a mirror image of last year. So if you look at the beginning of last year, this is late 2000. Let's just open this up. Let's see if we can see this in So if you look at this, you had MACD, right, weakening there. And this is bearish divergence at the end of 2021. And it breaks this trend line. And, now we have something similar. We're pushing against the trend line. If you look, depending on where you draw the trend line, you can see we were bouncing along these lows. I mean, you could also you could have had the trend line up here, depending on how exactly you want to draw it. But the key thing is we had an uptrend that there was divergence, and then we broke it. And the thing is that now we have a downtrend, we have divergence, and we're trying to break it. The other thing that's interesting is last year began with 2 bearish weeks. This year began with 2 bullish weeks. Last year began with a false breakout right here. This at the beginning of right here, I'm not putting on the chart, but the very beginning of last year, we tried to break out to new highs and failed. The beginning of this year, if I go back over, let me go back over to my TradeStation chart. Sorry, my zoom control is blocking part of my, how do I move that 1 second? All right, sorry. All right. All right. Let's make this a daily chart. Let me just kill this retracement for now. Where was January? It wasn't January 1st. It was January 3rd. This is the first day of the year. Look what we had. We had a false breakdown under 3,800 on the first day of the year. So the low occurred on the first day of the year, just like last year, the highs occurred like right around the beginning of the year. So all I'm saying with all this is there are certain parallels. Last year began with a lot of kind of complacency, just this kind of zombie drift to the upside. And this year has begun a similar way. Both of them were showing divergences, and they were showing signs of trend fading. And then we got the confirmation. So this is just kind of where I wanted to show you this. All right. Now let's see what else we see on. So this is the main sort of, I call it the kind of top-down view. I like to look kind of as a top-down, starting with the main sectors and ETFs. And if we look kind of in the last, week, what we've really seen is the risk on cyclical stuff really getting kind of hammered, like financials and industrials and small caps. Especially, it's interesting to see the way the small caps have suddenly started to really struggle yesterday. This was a big bearish outside day. It's also interesting that the NASDAQ, the Qs, also had a large bearish outside day. So both of those things were, kind of ugly patterns. Now, the one thing I'll say is that I have not found candlesticks to be massively significant in this current market. And one reason is because when you're chopping in ranges and stuff, things might just jump a lot. You have a big news day like yesterday because we had PPI and retail sales, and it simply gets ahead of itself. And from my perspective, that's not necessarily all that meaningful. I mean, it hurts and it causes a follow through the next day. But in my view, this is not overall just like the end all be all. And I think we're just still in the middle of the range, and this in and of itself is not necessarily the most bearish signal. To me, it all comes down to the S&P. And like I said, I think around 3,900 here, that 50% retracement. And then if we break below that, and then we break through the bottom of the triangle, or the lower trend line, that's when things would get more sharply bearish. The other thing that I'll just mention is the VIX. The VIX it's been very interesting to see the way the VIX has been kind of pushing back, under 20. And the question is, does it have the potential to keep moving higher? This is another thing here that I'll say is a very bearish situation, because the market is in a tight range and the VIX is very low. And the risk is that the VIX starts to explode higher. Then you have the potential for some real aggressive selling pressure. And on top of that, you have the fact that the market is already kind of at the lower end of its range, which would argue in favor of a more violent break to the downside. From my perspective, when you're at the beginning of a rate hiking cycle, that's when this is more relevant. In my view, is that the market now is kind of, we're most of this stuff is well known. And the bigger risk now is that if the Fed pauses, that the VIX moves lower and this sort of fear trade starts to evaporate. But again, not married to that. One thing that is interesting, let's put the 50-day moving average on here, because we go to studies, moving average one line. I always do it in red. So I'm going to make it red. Go to inputs 50. This is something I think I'm not the only person watching. This is still on the point when, lower low. If this stalls here, it would be a lower high. So let's just see, but let's also just realize that, if there is a sort of explosion higher in the VIX, what that would do. And you could even, to varying degrees, kind of extend this up here, depending on how you want to look at it. So there's definitely something happening here at the VIX. In my view, if it gets significantly above this level, above kind of like 22 to 23, then all the bullishness is really in question. All right. I don't seem to have any questions, so I'm going to keep going. So this tells us essentially here that the kind of recessionary fear trade is coming back. And as I look down here, I'm to see where the real strength is kind of in the last, say, month. The real strength has been in things like metals, the XME. But you see the industrials have been in a very kind of strong spot. But what's interesting is they went up to the top of their range and they died. But now they're coming back down to the bottom of the range. So it's also important to kind of realize that, this is a spot where there is some space, but a lot of that negativity is already here. So again, what do we have? A range. Just the point of all of this is a range. There's no clear signal or opportunity on this. We're basically just seeing that we got excited and we got beaten down. But if we get the belief of the Fed nearing the pause, then something like industrials would be an area that could benefit simply because of the economic kind of cycle that they're exposed to. I'm just looking down here, and at this point, a few things that did jump out to me was energy. We actually would have just gotten our energy inventory report. Let's actually take a look. This is crude oil. I'm going to go to I have a time delay on this, but let's actually see. I did not get to see yet what the inventory report was. I'm going to look on my other screen. To me, I've talked about how the energy situation has been, we saw a build of crude. The Strategic Petroleum Reserve basically had no draw out of it. Gasoline inventories built. So this is now modestly bearish for energy. And, that is a positive thing for the market overall. The inventories remain very tight, but, energy was something that I'd been watching, for some upside, and we did get some of it. If we looked at the XLE on the daily chart, we were talking about it down here. We did get some bounces out of it, but now you look at this is now not looking so hot. We got a lower high. We're back under the 50-day with the inventory build. And if we continue in this recessionary talk, I'm not going to call this a head and shoulders, but this is not something here that, that this could be something that is not bullish. And I think that's important to realize. And that would be nice in a way when you think about it, because downside in energy would be, it kind of moves in the opposite direction of a lot of other stocks. Most people probably like to see energy move lower. So I want to point this out. Another thing I've noticed is when you're early in a calendar year, very often you can see things that were strong in the past that everyone comes in complacently owning, like they were long tech at the end of 2021. And then it just gets liquidated. And I think right now we need to be careful of energy stocks because it could be in that situation. There is this argument that the Chinese demand is going to lift them and everything else. But I'm looking at this here, and honestly, this has been a level around 82 and a half. And I think we got to be careful here of seeing some potential here for energy to kind of break down and retest some of these levels. If we break under this 82 area in the XLE, you could, I think, see some longer term sort of real weakness in these names. And I can tell you, one of my favorite trades in the last 10 years has been shorting energy stocks. And obviously, it has not been something we've done recently, but when they go into a downtrend, they can trend pretty smoothly, and it can be opportunity. So I want to point that out because when something, you have all the hopes and it just kind of fades, that can be a good opportunity. And right now, to me, energy is definitely showing signs of fatigue here. This false breakout above the 50-day moving average is tricky. Something else I had on Market Insights was we had an interesting article. Don't point this out. It's a sophisticated thing. It's more a question of simply learning some of the things about options. But somebody did a trade in Citi, and they were basically short the puts at 45. So they basically were, short puts. This is a massive trade, 22,000 contracts. And they were at the 45 puts and the 45 calls. So they were short the puts and long the calls. And it was a synthetic long, essentially it's called a risk reversal or a combination trade. It's like a synthetic long, although technically a synthetic long is something different very often. But the key thing is that they were short the 45 puts, long the 45 calls in January. And they probably entered that position sometime in December. They got a really good rip out of it. And then they exited that in January, and they did the same trade they exited in January, and they did the same trade here in February at the 50 level. So at this point, they essentially have the equivalent of a very large position, and they're riding it by being short puts and long calls. Now, this is an institutional sort of trade that is not a great idea for individual investors. I mean, honestly, if you want to be long Citi, you can be long, Citi, just owning the shares and things like that. But what's interesting about this is that institutional investors sometimes what you'll see is they'll be selling puts because it simply allows them to get filled on a pullback without having to actually do the trade. It's kind of interesting to see how some of the big investors use options like that. So that was a strategy I was pointing out today. It's interesting because Citi has actually had some surprisingly good earnings, and they traded a very low multiple. They also have more of a global exposure than a lot of the big banks, which is interesting because the global trade has been strong. So I want to just kind of point this out. Citi might actually be a little bit of an outlier in terms of strength, and I want to point that out. Somebody is definitely putting some capital at work in it. At this point, you look at anything like this is obviously this level around 50 and a half, 50 kind of area. Not hard to see that. Looks like some trouble in terms of resistance. But I think there's a name we might want to kind of keep on the list. It's kind of like under the radar. And we've seen a lot of these under the radar names, you know, like Boeing just kind of come off the lows, or AT&T come off the lows. And it's a little bit of a market like that. Oracle, for example, just kind of comes off the lows. You know, it's like a kind of the forgotten former great stock, former, you know, market leader that suddenly just kind of it's not as bad as it used to be. I mean, Oracle to me is actually very interesting here when you look at you know, watch around the 84, 85 level here to see if this is something that gets a, you know, if it comes down and holds this sort of level. This is a strong earnings report. Now it's broken out through this level. So on this, I'm watching kind of for some potential of a pullback in this name. Now there are, however, some that are not looking so hot. And one of those is Ford Motor and General Motors. Both of these now look like they have, you know, some space to the downside. I wanted to point this out. These companies are just a hot mess at this time, from what I can tell. There's so many issues where essentially they've committed to spending so much money on electric vehicles and stuff. And, you know, it's just not what people want to hear right now. And I think that the risk of these companies is some of what they've committed to in terms of capital expenditure and everything else is just very messy. They have a lot of cyclicality risk at this time. So, you know, to me, the automakers here look pretty gnarly, and you know, there is some, you know, if you are kind of leaning on the bear side, just from a pure trending perspective, these have some space down. They also have this big gap on the 13th, and I can't remember what actually happened on the 13th to cause that. But they gap lower on the 13th, and they've held that gap. They gap down, bounce a little, and now the trend continues lower. They're under these moving averages. And you can also see here in these cases that the 8-day exponential is getting ready to cross under the 21. So these, to me, right now, just from a sort of trending perspective, if you're looking for things that maybe have, you know, the odds of being in a certain spot 2 to 3 weeks out, you know, for that sort of position, that this potentially has that kind of setup. All right. Another one are FedEx and UPS, cyclical names that have had some bounces back. I mean, FedEx here, right back to this level, kind of resistance. UPS, lot of downward trends in these, and I want to just kind of point out also tight ranges. FedEx is the one here that at this moment looks more kind of interesting to the downside. But you know, again, a lot of these are these kind of cyclical names. If we're gonna flick over to the recession, you know, these are some bad, you know, some ugly ones. You know, we talked about names like Caterpillar that have been kind of breaking out and stuff. And there are some arguments here for like Caterpillar. I was just talking to some friend of mine recently who you know, is actually trying to buy a big plow truck for you know, for a highway department. And they basically said that the cost of it has gone from like 250,000 to like 350,000 in the last year and a half. Now, Caterpillar doesn't make those per se, but all this heavy equipment now, these guys are really, they have a lot of pricing power. And honestly, I hadn't looked at Caterpillar until just now, but this is interesting here. And from my perspective, this is one that, you know, let's see here how it holds. It probably has, you know, a little bit more downside here, but this is actually a pretty interesting setup here. I'm looking at here for Caterpillar. Let's just do a little study. Let's go to next earnings date. Let's add to see when they report earnings. Earnings are on the 31st of this month. So interesting one here to bear in mind. A lot of these, what we're going to be wanting to do is look for, you know, moves after earnings. Let's just cover some of the other things we have in our workspace. I showed you the ES charting. Let's see, take a quick look here. I mean, it's the MACD has come off the low. It's interesting we see an inverted hammer here. I mean, like I said, this to me, I don't know, this looks to me more bounce worthy. Like I said, we're holding the 50% retracement of the move from the beginning of the well, from the December low, this 50% retracement here, we're holding. And now we have on the hourly chart, we're holding 3,900 on the cash, and on the hourly futures, we see some patterns that are interesting. For me in particular, this is it. We're setting up now for an inside candle, which is not necessarily a reversal pattern, but it is an inverted hammer. And that is kind of interesting here. So, if you think the bottom is going to fall out, this would be the point. I mean, honestly, this is now kind of, to me, starting to give the signal. It's starting to say that the whatever way we're going to resolve, could happen in the next, getting there possibly by the end of the next hour. So just interesting to kind of look at this because if we hold, though, we have an inverted, hammer, which is a reversal pattern. And if that happens at a 50% retracement and a level like 3,900 on the cash, this is the futures, but if it happens on the cash, all those things together, then you have some potential, signs for something of a bounce. The other thing is people are also, I'm sure, looking at the 50-day moving average, and we're basically also, well, we're actually under it now. So that has less relevance at this time. Anyway, this is very interesting, and these are just some of the signals that I'm just kind of watching. I mean, an inside candle, in my opinion, is usually a continuation pattern. It's not a reversal pattern. So this is not necessarily bullish, but it is interesting to see that we're squeezing into it. It means we have a consolidation. It means that, if you're tightening, you don't have maybe the force to drive it to the lows yet, but as it consolidates in the moving average and like this oversold condition gets worked off, then we have a little bit more. It's like it's like the you're winding up the clock a little bit for more of a move. And this, so I am not going to come out and be cockeyed bullish here. Like I said, my perspective is more that the market is overly negative and cash on the sidelines and reasons for hope, but that needs to be confirmed. And this is now a good time to practice patience. All right, let's see what we have on our other charts. This is a market breadth. This had shown a lot of positive indicators, and we did see this. And what's interesting to me was when I've noticed this before, which is interesting, which is that when this is the number of companies above the 20-day moving average and above the 50-day moving average. And I've noticed that when this crosses above, it gives some interesting, either way, bullish or bearish, it does give some interesting signals. And this has been another thing for me that has been, a positive, that we had this cross above. And usually when you get the cross above like here, it does kind of mark a period. So, of more of a turn. And if you look back, there's several instances. This is the market breadth for Masterclass Workspace that I've shared with you guys. And, this indicator here, the advanced decline line made a new high, which is interesting. If you look at where it was, the market made a lower high, advanced decline line made a higher high. So this is all signs of improving breadth. We look down here on the radar screen, which compares the RSP, which is the equal weighted. We can see that our equal weighted RSP has outperformed the S&P pretty significantly in the last month, in the last 3 months. That is a sign of stronger breadth. And that's just kind of interesting to see. It's also interesting that the same things happened on the NASDAQ. The QQEW is the equal weighted NASDAQ, and it's been outperforming, in the last month and the last 3 months. So these are the signs of positive breadth. And a lot of people kind of talk about this breadth indicator. I don't know. It's one of these things where it's, my one concern now with breadth is it a symptom or is it a cause? Is it simply following the market where things stop going down so you get the moving average crosses, or is it a real sign of internal demand? Historically, people have said that, breadth is a sign of real interest in buying stocks and things like that. But I'm also, when you start to see it, it's something to be positive about. But when it stops working, and if it doesn't, hold, and it kind of loses, this is not something to be hanging your hat on if it starts to break down. So we have seen this breadth has been true for the last 3 to 4 weeks, but if it doesn't work, then it'll get thrown out real quick. There's a pre-calculated indexes. It shows things like companies above the 200-day moving average and things like that. There's nothing all that interesting about it. I mean, it just kind of follows the market at this point. I'm not looking at this for very much. This is the sector analysis, and I mean, this just kind of shows where longer term sort of ETFs are doing versus the S&P 500, and it allows you to kind of see here, like for example, that it's interesting to me that steel makers have been kind of gaining recently, and we've talked about like the metals and stuff. And this is like just kind of interesting to see that there have been these sort of demand for things like steel and stuff. There was an interesting upgrade recently of Cliffs, CLF, which does iron ore. Actually, there's a name that is kind of interesting here. When you look at holding this level around 20, it had this big upgrade. This is potentially interesting. So I wanted to mention that the steel stocks, they have this sort of weak dollar trade in them, and they have been showing some relative strength. And it's interesting to me. You always have to be careful with things like this, because if it is just recessionary thing, then it's boom, these cyclical stocks can go right back down. But there have been some interesting sort of price action, especially in a name like Cliffs. And I was watching some of the copper names as well. I mean, Freeport here got way ahead of itself, but again, setting price alerts around like 41 on Freeport might be beneficial. It kind of did this before. It got way ahead of itself, and then the pullbacks was bought. And there are some interesting sort of cases here. So Freeport is one that we might want to have on our list. Anyway, I got that from the sector analysis. I'm kind of looking at which sectors have been doing best in the last month or whatever. And then what it does is it shows a ratio against the S&P 500. The Chinese internet stocks have been by far the best performers recently. But if you look at this on a weekly chart here, there are reasons here to think that maybe this is kind of a stopping point for now. This is some potential resistance, high. The gold miners have been moving, but I mentioned earlier that the potential of the dollar strengthening and things like that in these. So I'm not seeing much right now in terms of this. I'm actually working on something now. This is price channels. I'm actually going to write a blog post about it next week, but I wanted to kind of show how some of these price channels work. And actually, one of the examples I was going to use was GDX and KWEB, right? So this is hourly price channels. Now I changed the color. When you usually do it, you go to studies, add study price channels. It will bring up blue and red. I don't like that, because then it confuses me with sometimes my charts or moving averages if I have colored candlesticks. So I like to put it in like this kind of thick, bright white to see the top and the bottom. And what this simply does is it shows the high and the low in the last 20 candles, and it kind of gives you some levels here. But it is interesting to kind of see how this has been bouncing, kind of along these kind of levels. And, like for example, if you'd bought KWEB yesterday, it was, pretty much near these, kind of near the low here. And it's not exact, but it does kind of show you, wow, here's something's been outperforming. You can see that from the table. And here it is down at the bottom of the price channel. And so I have found this to be a useful thing. I've noticed that sometimes when things come down and hold these channels, like the gold miners, they come down, look right here, it was right at the bottom of the channel, and look what it did. And now here at the bottom of the channel bounces. So buying at the bottom of the channel can sometimes kind of be an interesting sort of approach. And I wanted to just kind of point this out, because I'm going to actually doing a blog post on it next week, just as a kind of thing about the platform. And I wanted to just kind of show it to you guys since I have it. All right. Well, I don't see much more. Let's just take one more look here, because this is not really holding up here. And I think the real issue here is simply the fact that if there is, this recessionary sort of thing taking shape, then you kind of have the worst of both worlds. And for me, I did not think recession was much of a risk until yesterday's retail sales with the November revisions. That to me was, yesterday was in some ways, for economic data, to me, the single most important and discouraging thing I've seen. And the reason, like I said, retail sales and industrial production both missed and were both revised lower. NRF said that this holiday spending was weaker than expected. The housing data was today kind of not so great, whatever. But to me, the real issue now is that I never really trust when CEOs say they expect a recession. I've seen CEOs have a tendency to set a low bar and come back, but some of the data that we've seen now is more leaning in that direction. And the Fed obviously can fix it. The question is simply, will they? Do they believe? They seem to have this belief that the unemployment needs to go higher. And are they going to push on that? And are they going to basically bury the economy? And they might. That might be what they think they need to do. I'm not really able to predict that, and no one is. But at this point, the market looks out and it basically sees we don't know anything for the next 2 weeks because we have to wait for the Fed report for the Fed meeting on February 1st and payrolls on February 3rd. And it simply becomes a difficult waiting game. So let's just kind of watch this level here and kind of see. Triangles like this will play a lot of tricks on your mind, and it's more a question of just letting the price resolve and see what happens. It's frustrating and difficult. But these are the signals now that are kind of popping up and the things to be watching. The last thing I'll mention is that, like Procter & Gamble, for example, actually there was one other set of things I did want to cover very quickly. First, the Procter & Gamble earnings were pretty bad, and it just kind of shows as well. I think it's important that the consumer staples have been, not this one, what is it? LW, this has been a good one, but GIS was a real rock star, just getting hammered. There's been, some of the consumer staples have been kind of losing their sort of, they've had some big pullbacks recently. And I just think it's important to kind of realize that some of these names, coming out of whatever the market does here, these could be at a point, especially Procter & Gamble. This company has been a favorite for so long. The earnings report was interesting. Basically, what they've done is they've raised prices to basically offset declining volumes. Now, I haven't done it in a while, but one of the things I've pointed out is that there's various catalysts for stock movement. One of the most important ones is volumes. First volumes, then margin, and then other things like macro and stuff like that. But volumes are probably the single most important determining factor of a company's success. If they're selling more widgets over time, they will make more money, and if they're selling fewer over time, they will suffer. And I think right now, Procter & Gamble is showing a lot of signs that it really has lost its magic. So I wanted to kind of mention that, and it's kind of true across a lot of these sort of consumer staple stocks. I mean, the fact is that some of these, they're not really as non-discretionary as people say. A lot of things like cosmetics and soda and stuff like that, it's easy when you have to pay more for gas to just not buy the 20-ounce soda in the gas station and things like that. So I think we have an interesting sort of thing here where some of these big consumer staples names really have not been looking great, and they might be going from bad to worse. But the other group that was interesting and is off people's radar, but the wireless tower stocks like American Tower and SBAC had some interesting sort of patterns recently. These names are kind of non-cyclical. They benefit. They're kind of recessionary, and they are still long-term growth names. It's pretty interesting when you think about some of these companies because they own like key real estate that is not that it's valuable because of wireless towers and these names, SBAC, and the other one is CCI, which I've not looked at these in a long time. But AMT was really interesting because you start to see this 50-day moving average pulling higher. This is one I wanted to kind of mention. These three stocks, CCI, SBAC, and AMT. And then Merck was the other one. This stock has been a rock star for a while here, and here it is. First pullback to the 50-day moving average in quite a while. This one popped up, and I found it. Let me just quickly show you price grid MA tools. So this is the how I found Merck today. I was looking for stocks at the 50-day moving average. I think if you look here at Merck, there it is. So this highlights companies that are pulling back 50-day moving average. It's one of the things in the masterclass July 2021. And then you can look for these other things like stocks pulling back to the rising 21-day. You know, I actually noticed this, and I wanted to mention the device makers, the medical device makers. Danaher began the year with an interesting sort of jump. Some of these names have shown some degree of relative strength recently. It was interesting because in many ways, the last 6 to 8 months was dominated by pharma over the device makers. The device makers were really weak for a lot of last year. And this year we're starting to see a little bit of relative strength in them. So I think that's kind of interesting. Agilent, medical device maker, BDX, medical device maker. This is kind of interesting to see this area. It's been a long-term secular growth area that honestly has been dead in the water for like a long time. These stocks have really, it's interesting to look at a name like Becton Dickinson. I mean, this company has gone nowhere throughout the pandemic and everything else. And if people are starting to look for something that is kind of have a safety play, some of these, you know, there's an argument in favor of them. And what's more interesting is they've shown some relative strength, and now they seem to have some interesting things happening with the 50-day moving average and a name like this coming up. So this is to me kind of interesting early in a year to be seeing if some of these names kind of start to come to life. So this is how I use some of these tools, but I just wanted to mention the main one I wanted to mention was Merck, because it had that pullback, which I found using the using this price grid, the MA tools on this workspace. So do you think FANG stocks have any upside in the near term? Well, things like Meta, need to see when the earnings are. For these, I mean, I think the earnings are such a big issue. And, you know, I've said that I am essentially more on the bullish side simply because of the fact there's so much cash on the sidelines and most of the bad news is well known. So if the Fed is going to be really kind of excessive and crush the economy, then that's bad. But if they stop raising rates, I mean, this market, I think, has much more potential to the upside. And I continue to think that. Look at Meta. You look at Amazon. These companies have been cutting prices. I mean, I'm cutting jobs, and you know, I would not, you know, I would not underestimate their ability to make earnings appear out of thin air. Profit-wise, there's a lot of ways these guys can boost their EPS. So from my perspective here, I'm more on the side that I think that my view would be more that the tech names here move higher, in hope of, first of all, weaker dollar is good for Microsoft and Apple. Secondly, job cuts are good for most of them. Thirdly, if the Fed pauses, then the entire narrative about multiples and everything else is no longer as much of an issue. So from my perspective, I'm leaning more on the optimistic side for the big NASDAQ names. Let's actually look at Tesla. I haven't looked at that one in a couple of days. I would say, though, that I'm not sure that there's any real significant move. It's more for me a perspective that they're likely to kind of hold here and chop around. And I would think that there's real strength. Well, we'll have to see. I mean, it could be, I'm trying to think of where the relative strength now even has been. Like I said, if things start to kind of break out and start to move, the bigger index is simply where things want to be. And it's difficult to look too much for the individual names, because if, for example, we get the sense of the Fed wanting to go more dovish and the market wanting to break out, you know, and it pushes through like the 200-day moving average, there's no reason to assume that Tesla is going to do well in that environment. It can be a broad rally. And so I think, again, the big triangle that we're looking at is what really needs to be our focus for the time being. So it's great to talk to everyone. Remember, this is the last one of these I'm going to be doing, but I will be back in 2 weeks on the 2nd. So right between the Fed meeting and payrolls, it'll be great to talk to you guys. Remember, we're going to be doing that one at 2 in the afternoon instead of 11 in the morning. But go ahead and check the events page and you'll get an update on it. And I will have a new set of zip files and everything by then. Great to talk to everyone. Have a great day.